Today, housing credit goes into reverse. Hello again, I'm Martin North from Digital Finance Analytics. The ABS released their housing finance data today to March 2018. The trends are pretty clear. Lending is slowing, and bearing in mind our thesis that lending and home prices are inextricably linked, this signals further home price falls ahead, which will be exacerbated by even tighter lending standards we think are coming. Now you can watch our recent video, The Absolute Link Between Home Prices and Credit, for more on this. And remember, debt is still rising faster than inflation or wages, so household debt will continue to rise from its already overextended levels. So now, let's look back at the data in more detail. Starting with the original first-time buyer data, we see a rise in volumes, reflecting the incentives in New South Wales and Victoria. On a rolling average basis, volumes are strongest in Victoria. Overall volumes were up 17.4% of new loans written, compared with 17.9% in February, which is a little higher than in 2016, but it appears to be drifting lower now, suggesting that ahead, volumes of new loans may fall a little. Looking at the first-time buyer month-on-month movements, we see there is a 5.9% uplift in flows, which equates to an extra 515 loans last month. The average loan size also rose by 2.3% to $235,000. Looking at the overall first-time buyer tracker, we see a fall in overall volumes as the number of first-time buyer investors fall away, as captured in our household surveys. Turning to the 12-month rolling trend, we see that both owner-occupied and investor loan flows are slowing, with investor lending shrinking faster. The proportion of investor loan flows slid again, excluding refinance, to 43.6%. And looking in more detail at the moving parts, in trend terms, lending for owner-occupied construction fell 1.1%, owner-occupied purchase of new dwellings fell 0.2%, and purchase of other established dwellings rose 0.2%. So overall, owner-occupied lending flows, excluding refinance, were flat at $14.8 billion. The refinance of existing owner-occupied loans rose by 0.5% to $6.4 billion, and on the investor side, construction of new property for investment purposes fell 3.8%, purchase of existing property for investment purposes fell 0.7%, and the purchase of existing property for investment by other entities, for example super funds, fell 0.2%. So overall investment flows fell 0.9% to $11.5 billion. And finally, the total of all finance trend fell overall 0.2% to $32.7 billion. And in original terms, the stock of all housing loans rose $6.7 billion or 0.4% in the month, which equates to 4.9% annualized, still well above inflation or wage growth, which of course is at 2%. So the overall growth of lending for housing is still sufficient to lift household debt even higher. So far from loosening lending controls, regulators should be seeking to tighten further. There is just no justification for growth above inflation or wages, because stronger momentum will only lift the burden on households even further and, of course, inflate the bank's balance sheets, which flatters their performance. If you like what you've seen here today, please like the post and add a comment or a question. I do read them all. And if you want to join the growing band of subscribers who receive alerts when we release new posts, do subscribe now. And I want to thank those who've already subscribed. I really appreciate your support and your participation. I'm Martin North, the Principal Analyst at Digital Finance Analytics. Many thanks for watching, and I'll see you next time.